Stocks and valuations probably not going to be as bullish as Tom Lee. So let's get your perspective. Always great to talk to you, Professor. So how do you factor in how fairly the market is valued right now based on what happens to earnings going forward? Not everybody's CrowdStrike.
Yeah. I think at the moment there are two big issues, two macro issues that are driving markets. One is what will happen to inflation over the next year, the next 2 years, and what the economy will do. That was true at the start of the year. It was true on February 1st. It's true on March 1st. But it's amazing how much the story the market's telling keeps shifting from month to month. In January, it was all good news. Inflation was going to be benign. The economy was going to come in for a soft landing. Stocks are up. February, the mood shifted. First couple of days in March, everything seemed great again. And today, the mood shifts. I have a feeling that this is what we're going to see for the rest of the year. And this is why I think market pundits need to step back from the fray, because the reality is we really don't know where the market will go until we see how inflation and the economy play out. Because I think those are going to be the big players that drive the market forward. It's not what the Fed does or what the Fed does not do. I think the Fed is a side story now. It's really inflation and the economy that's going to drive the market.
So in terms of inflation, it seems like for as many people, as many market pundits as we have on, there are different analysis of the inflation data, both in terms of what we get with CPI and PCE, and also more forward-looking, high-frequency data, factoring in rents, et cetera. What are you watching, and how is that shaping your assessment of inflation and how quickly it's coming off?
I think the one thing we can all agree on is that some of the inflation was caused by supply chains, COVID, and some of it is real. Some of it is caused by the spending we had during that period. I think the real question is how much of it is what. And I think that what I bring in is my age. I'm old enough to remember high inflation. And I know that, one of the things that I've always experienced with inflation is incredibly stubborn. You can bring it down a little, but it doesn't go away easily. So when people talked about bringing inflation down to 2% by the middle of the year, that goes against everything we know in history. So I have a feeling that inflation is going to be a lot more stubborn. And the words you're getting out of the Fed suggest that they too see the stubbornness of inflation staying up there, that the 2% is not going to be that easily reachable without something breaking in the process.
Okay, so you got this matrix that you showed us about what happens if there's no recession, steep recession, and inflation subsides or inflation stays high. It sounds like you think it's more likely inflation stays high, and in that case, you think that the S&P, I think this is index value, is going to end up below 3,800?
Yeah, and I think that's what you're seeing on a day like today. On days when you wake up to the recognition that inflation is still here, you're going to see the market under pressure. On days you wake up where you say inflation looks good, that's what I mean about swinging back and forth. You get one good inflation report, people are going to overreact. You get one bad one, you're going to go to the other end of the spectrum. So volatility is the name of the game for this year. And I think that volatility is going to be driven less by what you see in the earnings reports and more by what you see in inflation in the real economy. It's a macro year, not a micro year.
Aswath Damodaran, we appreciate it today. Thank you.